Hi everyone, welcome to Malethabo Accounting Academy. So on this tutorial video, I wanted to actually look into, it's going to be based on T account. It's going to be based on general ledger. So what I did, I had compiled, I've compiled 8 transactions. So I've compiled 8 transactions that I would like to basically explain to you. I've written them down. So I've got here we go. So I've got 8 transactions that I have compiled, and I would like to basically not show you, but rather explain to you how you would record these transactions on your T account or on your general ledger. Okay, let's get on to it. So the first transaction says the owner contributes 50,000 cash to the business. Okay, so this is capital contribution. The owner contributes 50,000 cash into the business. So first things first, we need to identify what are the 2 accounts affected by this transaction. So the 2 accounts affected by this transaction, it is capital account and it is the bank account. So let's look at your capital account first. So I would advise that you have some sort of scribbling, that you get your exam pad, get your pen, and then you write as I talk you through this. So let's start off with the capital account. So on your capital account, um, on your credit side of your capital account, you're going to record your 50,000 there on your credit side. Why? Because capital increases with an entry on the credit side. And then on your bank account, you're going to record that 50,000 on your debit side. Why? Bank is an asset, and assets increase with an entry on the debit side. Okay, let's move on to the next transaction. The next transaction says purchased trading inventory for cash, or on cash rather, of 20,000. So that means we as a business, we purchased trading stock from our suppliers, trading stock that is worth 20,000, and we've purchased it on cash. So what are the 2 accounts affected is the question you need to ask yourself. Now the 2 accounts affected, it is bank because we purchased on cash, and the second one, it is creditors. It is creditors. No, it's not creditors. I'm lying. Sorry. So the 2 accounts affected, it is bank because we purchased on cash, and it is trading stock. Yes, it is trading stock. Okay, so now let's look into the bank account. So remember, we purchased this trading stock on cash. That means we took money from our bank account and we went and bought from our creditors. So the bank balance has decreased. So that means our bank account so that 20,000, we're going to record it on the credit side because the bank balance has decreased, and bank is what is an asset. An asset decreased with an entry on the credit side. Okay, and then the next account is trading stock. We went and bought trading stock worth 20,000. So we came back into our business with stock. That means now our stock balance has increased. What is stock? Stock is an asset. Assets increase with an entry on the debit side. So that means you're going to record on the trading stock account, we're going to record the 20,000 on the debit side. Okay, let's move on to the next transaction, which is purchased inventory. Yes, purchased inventory of 70,000 on credit. Yes, on credit. So now that means we went and bought trading stock worth 70,000. We bought it on credit. What are the 2 accounts affected? It is trading stock and creditors. Our creditors control. So let's look at trading stock. So our trading stock is increasing because we went and bought. Now, what is trading stock? Trading stock is an asset. And assets increase with an entry on which side? Asset increases with an entry on the debit side. So we go under our trading stock account, we're going to record that 70,000 on the debit side. Now let's look at our creditors control account. Now creditors control is increasing because we bought on credit. We bought that stock on credit. So what is creditors? Creditors is a liability. Liability increase with an entry on the credit side. So that means under trading, under creditors control, which is under the creditors control account, we're going to record that 70,000 on the credit side because creditors are a liability and liabilities increase with an entry on the credit side. Okay, let's go to the fourth transaction, which is sold trading inventory with a cost of 60,000 on credit for 100,000. So we as a business, we sold trading stock that cost us 60,000, but we are selling it on credit at 100,000 selling price. So what are the two accounts affected here? So the two accounts affected here, it is sales and it is debtors control. So on sales, what is sales? Sales is an income. So on your sales account, you are going to record the 100,000, which is the selling price on your credit side because our sales have increased, right? And then what is sales? Remember, sales is an income. Income increases with an entry on the credit side. And then we also said debtors control. Debtors control meaning we sold our trading stock to our customers, but we sold it on credit. And what is debtors control? Debtors control is an asset. Assets increase with an entry on the debit side. So that means you're going to record that 100,000 selling price on the debit side, right? Okay, now let's move on to transaction number 5. Transaction number 5 said paid 2,000 in cash for electricity. Okay, so now we paid electricity 2,000 in cash. What are the two accounts affected? The two accounts affected, it is electricity and bank. So let's look at bank. Because we paid, so money is going out of the bank account, therefore our bank balance will decrease. Therefore we're going to record that 2,000 on the credit side of the bank account because bank is decreasing and bank is an asset and asset decreases with an entry on the credit side. And then we're going to look at electricity. Electricity is what? Is an expense. Going to look at the electricity to account. Electricity is an expense. And expenses increase with an entry on the debit side. So on the debit side of the electricity account, that's where we're going to record the 2,000. Okay, now the next transaction, number 6, the owner took 5,000 cash out of the business's bank balance. So what are the two? So Lana, what happened is that the owner of the business took out 5,000, cash out of the business's bank account. So what are the two accounts affected here? The two accounts affected here, it is drawings and bank. Let's look at bank. So our bank account is decreasing. Therefore, we're going to write on our bank account, we're going to write that 5,000 on the credit side of the bank account because the bank is decreasing. And what is a bank? A bank is an asset. An asset increases with an entry on the credit side. And then let's look at drawings. So drawings, what are drawings? Or rather, drawings increase with an entry on the debit side. Remember, drawings are increased with an entry on the debit side. So as a result, you're going to write on the drawings account, we're going to write this 5,000 drawings on the debit side. Let's move on to the next one is and interest of 105 on the business's current bank account. So we've got two accounts affected here. It is interest as well interest income, as well as I'm looking at the time. Oh my gosh. Okay, this is the last transaction I'm gonna do. So it's interest and bank. So bank is increasing. Bank is an asset we're gonna record on the debit side of the bank, on the bank account, and interest income is an income and increases with an entry on the credit side. We're going to record that on the credit side of that income account. And then the last transaction is paid back suppliers 5,000 cash. So we were owing our suppliers, right, 5,000. So now we are paying our suppliers. So what are the two accounts affected? The two accounts affected, it is bank and creditors control. On our bank account, since we are paying our suppliers, that means bank is decreasing. We're gonna record on our bank account, we're going to record on the credit side of the bank account, because bank is an asset and assets decrease with an entry on the credit side. And then creditors control, remember this, creditors control. Creditors control is a liability, right? And we are paying our suppliers. That means we are decreasing our liability. Therefore, we're going to record on our creditors control account, we're going to record on the debit side, because creditors is a liability and liabilities decrease with an entry on the debit side. Okay, that brings our today's tutorial to an end. It's rather long, but it's okay. So that's the end of this video. And on the next tutorial video, I'm going to, so basically I had someone on my comment section, Ntokozo Hlatshwayo, so he requested that I do a tutorial video on value added tax, on VAT. So the next video will be based on VAT. Thank you very much for watching. You're more than welcome to comment down below if you need some clarity on the transactions that we're going through, you don't understand something, you want me to explain. You're more than welcome to ask me questions. Thank you very much for watching once more.